Welcome to MacroHive Conversations with Bilal Hafiz. MacroHive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com. Now, on to this episode's guest, Tom Montag. Tom is the founding chief executive officer of Rubicon Carbon. Tom has over 20 years of experience in financial markets. Previously, he was a chief operating officer and president of global banking and markets at Bank of America. Tom was also a member of the company's executive management team, overseeing all businesses serving corporations, institutional investors, and government entities. Before this, Tom was a partner at Goldman Sachs, a member of the management committee, and was co-head of the Securities Division. He serves on the boards of Goldman Sachs, Deschutes Land Trust, the Hispanic Federation, the Japan Society, and is a trustee of Northwestern University. Now, on to our conversation. So greetings and welcome, Tom. It's fantastic to have you on the podcast. I've been very much looking forward to speaking to you.
Well, thank you. It's great to meet you. It's a beautiful day here in New York after a few days of rain, so I'm excited to talk to you.
That's great to hear. Well, before we go into the meat of our conversation, I do like to ask something of the background of my guest. So it'd be great to hear in your own words your origin story. You know, perhaps, I don't know how far back you want to go, but maybe what you studied at university, and was it inevitable you'd end up in finance? I mean, what was your background there?
And nothing inevitable about it. I grew up in Oregon, in Portland, Oregon. I start with that because my family came over from Europe and we made wood-burning stoves. Now I'm in the carbon market, so I always find it interesting that my family came over here. They were called Montag Stove Works, and I actually own a couple of Montag stoves from back in the day. They no longer exist as a company, but they had their run in the early 1900s. Then after I went to school in California. My first job, back to the finance part, my first job, I never worked on Wall Street. I never really been to New York, was working for it was a big company, but at a small strip mall for a household finance company, which is, I don't know who bought it eventually, but basically was a lender of last resort. And my first job out of college was collecting bad loans for household finance, and these are loans that and the office was next to a racetrack at the time. So when the races came through, I'd have to go through, and all the people that moved there, I would get their accounts and try to collect bad loans. So that was my first job in finance. I left that quick.
So really, really in kind of the heart of the sort of banking, finance side there. Yeah.
And then after that, I got my MBA and I started working first for a few years. My summer job was at JP Morgan, and I worked in the M&A area of JP Morgan. And then I decided I wanted to live in Chicago, which is a great town. And I went to business school at Northwestern, and I worked at First National Bank of Chicago for a few years, which of course now is part of JP Morgan through Bank One. And then I got involved in derivatives. And so at that point, I was actually hired by Goldman Sachs to join them in their derivative unit. And I eventually became a partner there. And I put the first derivative on Goldman Sachs's books back in the day. And
wow, okay.
And we also
you really were there at the beginning then.
I was in the beginning. I was the vice chairman of ISDA for a while. And we also were the first people, now they have all these valuation adjustments in the derivatives world, FVA, CVA, so on. We were the first guys to use CVA. So we kind of invented the credit valuation adjustment, for lack of a better term. Back right around when we were going public in the late 90s to value our book. And of course, since then, people have got much more efficient in how you value things and what you do with things. And of course, and others invented the credit derivatives. But I then, I went to Japan and London and worked for Goldman. And then I joined John Thain at Merrill Lynch in 2008 in August. And a month later, they were bought by Bank of America. And I stayed at Bank of America as the chief operating officer and president of global banking and markets until 2022. So that's my journey to get to the seat I'm at today. And I can talk a lot about more where I am today now.
Yeah, we'll talk more. But before we do that, obviously you've had some very senior positions, in some of the top investment banks or banks in the world. I mean, today when you look across the financial sector, you have kind of investment banks still kind of around, obviously, but you've had the rise of private markets, which has become quite big.
Yeah.
You've also had the rise of digital as well. And then you're
you're on the carbon side, which is interesting. But before we get to the carbon side, I mean, how do you look at the current landscape? Because obviously it's very different to where it was 10, 20 years ago. So like in your mind, do you have a mental map of, okay, this is how the financial sector looks today?
I haven't, I'm also on the board of Goldman Sachs. So after I left Bank of America, I was asked to be on the board of Goldman Sachs. And so I'm also on the back at Goldman in the board there. So clearly we look at that all the time. Interestingly enough, many of the players are it's different than it was 10 and 20 years ago, but the players, it's the same names and a lot of same names in the uniform as far as the public side is concerned. The two things, first, it was fintech that was going to change everything, and it hasn't. I don't think it really has changed everything. If you look at the payments businesses and those kind of things, still the banks dominate a lot of most of the volume of the payments business around the world, and the FX business and all those things. Well, there are many fine players in that space, and some of these guys like Stripe and et cetera have done a great job. It's still a big business for the banks, and then. So that phase of fintech, which is still there, and still a lot of things to do there. And then you kind of come to the private side, which you mentioned, which is these big funds that have come up that do private debt all over the place. And really, they're not only big, but they're important in the fabric of the structures now as to what banks can and cannot do. After 2008. Banking changed a lot as far as the capital rules and what you were allowed to do and how long you could lend and what your portfolio could look like. And so there was an area where more capital was going to be needed. And I think the private guys have done a great job of kind of going into that area and finding value and lending money.
And so in terms of your, post sort of conventional bank, background, you could have gone into private markets. I mean, I know so many people who, did very well in sort of traditional investment banks, then they moved into private markets in some form or another. But instead, you forged a new path, so into climate, carbon, emissions, sustainability, and so on. So what motivated that?
Well, two things. I had long been, being from Oregon, I was a bit of an environmentalist, and I'd been involved in this group in Oregon called the Deschutes Land Trust, where basically kind of like a mini nature conservancy. We had been buying ranches basically throughout central Oregon or in the Bend area around the Deschutes River, and taking the canal. They had taken all the streams and a lot of these meadows, and to control flooding, they had the Army Corps of Engineers largely had put canals in, and so you could graze and all that around them. And so it really hurt the salmon runs. And so we wanted to restore salmon. There were salmon runs in Central Oregon. So we would buy these properties charitably, and then we would move the canal back into its natural, let it find its natural path, and then you had to replant everything to provide the eddies and the shade and everything for the smolts to grow up as they were going along. And so we'd been doing that and buying those things. And so I was really into what was happening. And a lot of the problem was how much hotter the rivers were, because springs had been buried and it was just hotter. So the environment for the fish to grow up is better at certain temperatures of the water. So I was doing that work and then I got a call from people I knew at TPG that I'd known from Goldman Sachs.
TPG, just for the audience's benefit, is
it's a private equity. It's a private equity group, which does have a private capital arm now. And they said they had been working on the voluntary carbon market, had done a lot of work around it, and they thought a new market was going to emerge around this. And because I had been so involved in sales and I ran sales and trading at Goldman, co-ran sales and trading at Goldman, and also I did in derivatives, which was a market that grew up as I grew up. That I was involved in the environment. Would I be interested in helping them start this company around the voluntary carbon market? And I said, yeah. I mean, it sounded like, it's literally a startup, and it's something I'd be learning all the time. I was very interested in it. And it sounds like I could take some of my knowledge from my, world of finance and living around the world, and hopefully do some good around the climate problem.
And that's great. And when it comes to carbon markets, there seems to be, and forgive me for my amateur analysis here, but there seems to be sort of two sides to it. There's the sort of mandatory side, which is all the emission standards or limits that countries impose based on their climate goals that they have, and those are mandatory. And then you have a cap and trade type arrangement where people can trade their allowances and such. There's kind of those sorts of carbon. Then you have the voluntary carbon market, which is obviously by its name voluntary, and that's kind of outside of that. So you have these two types of markets. Is that a fair way of sort of looking at the market?
It's a fair way of looking at the market. I thought, of course, well, how great is this? It's a voluntary carbon market, and people are doing it voluntarily to do projects around the world that that reduce the amount of carbon in the environment. But it turns out it's a bit of a controversial topic. So you have the compliance markets, which in and of they themselves can be somewhat controversial. Many of them are taxes in essence, but also provide the benefit which you mentioned. But in the voluntary market, somebody remember when everybody was making pledges around they were going to have a net zero, and so people thought, and I still believe that it was very hard to decarbonize everything that you were doing, and so the offset market, voluntary carbon offset market, came up which said, well, if you can't get rid of 1 ton of carbon in your chain, then you should be able to remove if you planted some trees that would not otherwise have been planted, those trees would remove that carbon that you could not get out of your system. And so that was the basic premise of the voluntary carbon market and doing offsets. The issue is, as I've got into it, is one, there's some people that don't believe in climate change at all. So you knew you have those people. But even within the group that believes in climate change, there are some people that don't believe in offsets and don't want to have offsets and want everything to be inset. And so you just have this back and forth amongst people about, is it good? Is it bad? Is it credible? Is it not credible? Does it do good or does it not do good? And to me, it does good, obviously, or I wouldn't be in this seat right now.
And the controversy is usually around one, I guess, would be, does it actually lead to lower carbon emissions? And I suppose the other one is greenwashing of some kind. That's usually
well, that's controversial for everybody, though. Nobody wants greenwashing. Nobody wants nobody wants them to claim that they're doing something that they aren't. But but because some projects don't work out or the science isn't perfect, there are some projects that don't do what they thought they were going to do. That happens, of course, even in construction and many other projects that have these long terms to them. So that's not controversy in and of itself. It's just the fact that it happens, and therefore it's put credibility for all things under a microscope, because if some are bad, maybe they're all are bad. And one of the premises of Rubicon, when TPG set it up, was we have a great science team here that goes through the projects, and we have an integrity framework, and we publish that. And we do what it would be very hard for somebody to do. Think about buying stocks and how many people look at companies and decide, should you buy them and should you not buy them? And you can go to somebody at Deutsche Bank and somebody at Goldman, and they're going to have completely different opinions about whether you should buy a stock and where the price is going. You can imagine these projects and where they are and their startup projects. People have different opinions about them and what's going to happen to them. So.
Yeah. And so if we can go through an example to understand how this works. So for example, let's say I'm a manufacturing company and I want to enter into an agreement, like buy a carbon offset because somewhere in my chain, I want to get rid of some carbon. So I then come to you, Rubicon, and then what happens, then?
So we go through all the alternatives you have to reduce your carbon, like what kind of projects are out there and the products that we sell. The core product that drove the company at the beginning was called a Rubicon Carbon ton. And the idea of the Rubicon Carbon ton is kind of like an ETF, that if you bought 1 ton of the Rubicon Carbon ton, underneath that would be a portfolio of projects that we were always managing to make sure we thought that they had the credibility and a ton was a ton. And so if you wanted to buy now and retire in a year or 2 years or 3 years, you could hold that and we would be monitoring and doing the ton below it, or you can buy it and retire it at the time. And we had 3 different types of tons you could buy. One is removals, 2 is what we call super pollutants or industrial emissions, methane and things like that. And the 3rd is nature-based. And so you could buy those, or if you're a big buyer and you want to, you can also buy individual projects or individual tons. And so we would we would help them in their journey about how many tons do they have, first of all, and then what are the different alternatives they have for doing it. And some companies, by the way, have their own in-house people that know a lot. Other companies are doing small amounts, really can't afford that. And so we try to service both sides with the different parts of the company.
Okay, understood. So you mentioned three types of also products: so removal, super pollutants, and the nature-based ones. So
yes,
let's take the nature-based projects or carbon offset. So, how would that work? And who oversees that? How do you sort of verify it will deliver on carbon offsets?
Well, the way the industry works is that a developer let's say you wanted to protect a forest somewhere, and there were rules around, and there's different registries, and you go to those registries, and they have rules for how they will give the developer the credits. And so you have to have a project that meets the rules or standards of that organization. So the big one in nature is the Verra registry, and so there's REDD Plus projects, and so you would go to Verra with, we would like to do this using your standard this, and they would decide to say, yeah, we'll issue you 1,000 carbon credits for that. And you would keep going every year, because remember, these projects are, as long as it's growing and the science is there and the area is being protected and satellite imagery makes it look okay, you keep going for those credits through the life of the project. And so that's how it worked from a developing standpoint. And those developers need to get money, and they get money oftentimes by investors like us investing in them and getting the offtake or the credits that come out, and then selling them to people that need and believe in voluntary carbon markets.
Okay, understood. So that's the kind of the supply side, and there's the demand side from whoever. But key thing in all of this, I suppose, are these entities or institutions, or even like yourself, who verify everything. So you kind of need multiple different institutions to make sure that everything is happening to standard, isn't there? That's probably the big challenge, I suppose.
Yeah, well, Verra itself, the registries themselves have to make sure that they think it's going, and then of course we help the buyers. We buy some that we keep on our balance sheet and sell. So we do our own MRV and science work on that. There's other firms that do that as well. There's also rating agencies now. So you can go to, there's a agency called B0, for example, that puts out ratings on projects and tells you what the risks are and those kind of things, as an analyst would have done in the back in their day.
And earlier you mentioned that you were around during the early days of derivatives, and you were sort of involved in ISDA as well, which is sort of the standard setting sort of body. Do you think there are parallels between those days and today in the carbon market?
I do, because first of all, at the beginning, everybody had their own document. And so you'd be negotiating everybody's document with them, which is what happens here. The day, the terms weren't predefined for everyone to use. And so you'd have to make sure you were using terms that you both agreed with. And then the dates that things would happen, like T+2 and all the things you've come to expect in the financial markets. Here, people will say, can I pay you at the end of August? It's almost more of a procurement thing. It's not a financial instrument for them. It's a procurement thing. And so it goes through those kind of standards. And so now it's this, you can't, in the early days of derivatives, you made it so you could, I could sell my Goldman Sachs swap or assign my Goldman Sachs swap to Deutsche Bank as long as all parties agreed, because the document was standardized and so on. So you have that part. And the second part that's the same is that people like to customize for themselves. And so one of the great things about derivatives is no, I need to meet these dates, and I want to have this index, and I want to have these holidays, and I want this exact date for the maturity, all the things that you can, and so here people like certain kinds of projects. They want projects that are in certain countries, or they want projects that give certain amount back to the community, or they want some that also impact water and wildlife and any of the other environmental attributes that are out there. So it's kind of the same in the sense that you're picking from a kind of a hamburger, one of those menu lists. You're picking, derivatives was like that. You would pick, I want commercial paper, I want T-bills, I want LIBOR in the day, I want compounding, I want quarterly, daily, monthly. It's like that in the sense of all the different projects and all the different things they do and all the different attributes they have outside of carbon that people look at before they actually buy a carbon ton.
And so, I mean, how close are we to that market today in the voluntary carbon market?
We're not very close, I don't think. I mean, people are trying to do things that make it more commodity like, so that, you buy a ton, like when you buy a barrel of oil, you're just buying a barrel. I mean, there's different kinds, of course. There's West Texas, et cetera. But in big chunks, you can just buy it. You don't have to worry about it. But here, because that carbon removal, one, you can't see it. And there's science that's telling you how much there was. And after the fact, there could have been errors in their calculation, or they assumed something that they shouldn't have, or something happened in the project. There's just so many degrees of freedom that you don't really have that assignability and all those kind of things that you want to do. The vast majority of people buy and retire immediately. And when you retire, it's done, right? It's not like when a bond matures, the bond's gone. It's done. And there's not really a mechanism to make it not a ton. And so, which is one of the, I think, if I buy a ton, even if it has the credibility is lacking, when I use the ton, it basically still says it's a ton when you retire it. Now, we also offer what we call risk adjustment. So if we think something has been overcredited, we have different ways that we kind of try to make sure that your ton is a real ton. But basically, once you get it, it's called a ton. And that's what people don't like about the greenwashing, because that ton might have been, in retrospect, not really a ton.
And you mentioned the risk adjustment, and you said you use the term overcrediting. What do you can you explain a bit more?
Oh, sorry.
By that?
Yeah, sorry. I go in the little buzzwords. Overcrediting is when a project has been given more tons than it might have, that it should have gotten, in somebody's opinion. And so a lot of it's due to the baseline of the project in the first place, how much deforestation was really happening. So when you protect an area, how much of that area are you really protecting from being deforested? And by the way, because these are 40-year projects, a 1 or 2% difference in what that number is has a big impact over time, because it compounds over many, many years. The impact is very big for stuff that isn't that precise, by the way. You have to make assumptions about, well, was the housing still going to go out here, and were people going to cross this river, and all the things that you think you have to do to protect the environment. And so it's just not, it's not math. It's not as much, there is a lot of math, but it isn't as much math as an options equation as a math.
And things like, again, kind of doing the parallel with sort of traditional financial markets, can you post carbon credits as collateral, and then use that to leverage in the conventional way? Can you short carbon?
No, I mean, you can't really. There's not, I mean, somebody might have lent against. Well, we're trying to do things like that, but I wouldn't call it a market. And so there's these things called offtake agreements or streaming agreement, which is a common thing in mining, but in carbon, where somebody agrees to buy. We just announced a deal with Microsoft where they agree to buy carbon credits over a certain period of time. Under some standards that you have developed with them. And so in that sense, you can get offtake agreements. And the question is, can you borrow against those offtake agreements? And because one side of the equation, you have the demand side. The supply side, though, still has these risks of the places you're doing these things and the permits you need to get. And you also have weather and all those things make it still a risky, although a lot of them, like for us, a lot of the things we do are called ARR, or kind of reforestation. It's planting trees, but it's a lot harder than you think it is when you do things in that kind of scale.
Okay, yeah. And then in terms of the geography of voluntary carbon markets, I mean, what are we talking about here from the supply side of like where you get, where this reforestation occurs, and then from the demand side, like who are buying the credits?
The projects are all over the world. So you can find a project virtually anywhere. I mean, we're working on projects right now that are in Uganda or Ghana or India or Indonesia or the United States or Mexico. I mean, it's hard to think of a place, South Africa, Panama. I mean, they're everywhere. And so a lot of it's global South things. And so that's really good. And we invest money in those projects in those places. But they literally are everywhere. And so that's good and bad, because there's geopolitical risks in places, and the rating there isn't so good. And also this market is going through a lot of changes, not just from the voluntary market, but there's United Nations sponsored type things that are going on for countries that entered the Paris Accords, et cetera, that have put their own, net zero goals out. And so you have to work with the countries and whose credits are these, and make sure you can really sell them, and you have the validity of the country behind it as well.
And then you mentioned sort of Microsoft,
Yes.
You've done work.
With, the buyers, yeah.
One of the big buyers. And,
Yeah.
Is that common for like tech companies? I'm thinking more about AI, data centers, huge energy demand. So I can see how that all makes sense.
Yes. Yeah, the tech companies, like you can look, there's sources where you can see who, about half of retirements are done by people publicly, so you can see who did it. And about half of them are by private, where you cannot see who did it. But if you look at the public side, you can see the kind of people that do it. It's a pretty concentrated market. I think last year, I don't remember the exact number, maybe 50 companies were 80% of the North American market, and 120 companies were 80% of the world market. So it's very focused, but similar to big companies on NASDAQ or something, some guys really drive what's going on. There's lots of people that are doing smaller amounts, but then the big guys tend to be the tech companies, or they can be in the energy space as well.
And if we talk a bit more about Rubicon itself, it was set up about 3-4 years ago, from what you said earlier, and the way you're describing it is almost like a BlackRock of carbon credits. Is that fair characterization? And what do you mean by that? I mean,
but by that I meant, like, how individuals or companies will give BlackRock their money to invest. And they'll say, we want to be, either they have a separate fund where they say, these are the things I want, or they have, they go into pre-existing funds that they like, either of them. And BlackRock has done an incredible job of that. And BlackRock, of course, has the ETF business. So when I made that statement, because the idea is that people would come to us and say, listen, we need to have 100,000 credits in this following time frame for the next 10 years to meet our goals, and we would manage a portfolio for them to get them to have 100,000 quality credits over that time and period. Just like a pension fund would come in and say, we need this is what our goals are, these are our risk tolerance, this is what we want to do. And so we would be their science team, we would be managing their credits, and we would be able to deliver to them the quality credits they need for the next 20 years to meet the goals they have internally and externally.
And could we consider carbon credits as an investment asset class by itself? So an some fund management company, asset management company who holds like bonds, equities, commodities, private, could they add carbon as well and use it as an asset class, or is that not the right way of thinking about it?
No, well, we're doing that, right? So we're investing. So we're investing in projects kind of at source, and then and what we're getting out of it is the carbon credits to sell to people. We try to sell them at the same time as we're doing it, like a power plant might when they were developing power plant. So the answer to that is yes, but as far as getting in like much later, like today, and buying it for it to go up, yes, but there's so many projects, and there's so many projects out there, so it's hard to understand which is going to go up and not going to go up. And it's not a liquid market. Like the bid offers are pretty wide, so you would have to have a real strong opinion, I think, to take much of a risk right now.
And then, what do you see as the main trends we should be looking out for in the voluntary carbon market for the next couple of years? I mean, what are the key things on your mind, and what's the important things that audience should look out for?
Well, one of the things I've always been about, you might like this given your background, is like there's no time value of carbon. So like they don't say that if you do, and it's true, if you remove carbon from the atmosphere today, it has a better impact than removing carbon 20 years from today.
Yeah, absolutely.
Right. But people don't think that way. They say my target's in 2050, and so I need to have enough by 2050. And the way people kind of do the math really of that is just how much carbon have I been putting out, and how much carbon how much carbon do I need to remove, either from insetting or from offsetting. And they don't really think, if I do it today, that this one today is worth three times. I'm making up the three number, but is we're three times doing it in 25 years, which is probably roughly right. Maybe it's five times. So, but we don't give them that benefit really in that. So we don't incentivize the right way. We don't incentivize them to do today what they instead everything's one. And if you did one in 2030, it's the same thing. Not only do we do that, but the market, because of the risk of transactions, many people don't want any carbon credits that are older than 5 years. So they're called vintages, kind of like wines. Like the carbon credits are issued by years. And so if something's a 2018, it will have a lower price than something that kind of like the off the run and on the run treasuries kind of. Which is ironic given what I just said, because in theory, if the 2018 credit was from the same developer on the same project as the 2025, it should be worth more because it's actually done more good than the 2025 one. And it'll always be ahead of that one, but the market doesn't value it that way because the risk of it being wrong or something happening is higher, and so they don't really want to do anything that's considered old. And standards change. And so as standards change, you want to keep up with the new standard that comes out.
I'm wondering, I mean, how could one go about trying to get the market to value the time value of carbons? I mean, would that require like, government-led sort of policy or something to somehow incentivize people through sort of tax, like earlier, like some kind of tax benefits? I'm just wondering how one could go about sort of trying to get that forward. Right.
I think just like when people say this is how much carbon I emit and this is how much carbon I have taken out, that if we allowed them in those equations to allowed them to compound the value of doing it today.
Actually, you're right. Yeah, it goes to that level. Yeah.
Right. So it's really, if you look at, there's groups like the SB, and I don't know how SBTI works, but there's a science-based group that sets targets and measures you against those targets. If they were doing that and others were doing that, then by definition, you'd want to buy more today because you'd say, well, I get the value of compounding, versus now you really don't get it, so to speak.
And in terms of this move to, it does seem like this kind of move to standardization would help the industry a lot. I mean, how can that happen?
Well, a couple things is hard, because remember, in derivatives, you're talking about big banks. In this, a lot of the credits are owned by small developers in small places, and so you do have this credit angle that you have to be willing to invest in their project. We have to invest in their project. At that level, I don't know how much really there is. But once it's but once the carbon credit's been created, right? It seems like it should be able to be traded around a lot more amongst people, and there should be standardized ways. And if you could do that, if you had liquidity, if you have liquidity, you reduce your risk. So your risk of buying and owning becomes less if the bid offers are less and you feel like you can get in and out of positions that you had. But here, if you get in, the cost of getting out, even if it's fine, it's expensive to get out. So you have to have real conviction in that position before you do it, because the bid offers are too big.
Now, I did want to round off with a couple of more personal, lighthearted questions. But before we do that, did I miss anything that you wanted to say about VCMs or what Rubicon?
Oh no, just that. I mean, I want to do a little bit of a commercial. Like we announced 2 weeks ago what we think is the biggest ever carbon deal with Microsoft. I mentioned before, but it was 18 million tons of carbon over a 20-year period. And so we're in the midst of developing 10 or 12 projects to meet the very high Microsoft standards, where we're going to be investing all over the world in big projects that will reduce carbon. And we're obviously proud and happy to work with Microsoft, but it's a lot of work and a lot of fun, which is why I kind of ended up in the space in the first place. But we're very proud of that. And we hope, one of the ideas also was that our company was backed by TPG, institutional. We were very institutionalized. And so people would have more comfort dealing with us, because not only are we institutionalized, but we have people involved in our company like myself, Dr. Jen Jenkins, who's one of the renowned scientists in the world around this, runs our science department. Anne Finucane, who used to be vice chairman of Bank of America with me, is the chairman of our board. Gina McCarthy, who was EPA, ran the EPA for Obama, is on our board. So we really have an institutional backing and power, and that would make people more comfortable with the market. And so hopefully the Microsoft and who we are will help this market get going and become the market. I think we need to control climate change. I think the money that we can, if we get this right, the money that will come into this area and fuel all these projects all over the world can be great for this world. So
no,
just that little commercial. Yeah.
No, great. Yeah, I love it. I did want to round off with a couple of personal questions I asked my guests. One is, what's the best advice you ever received from anyone around investing?
Oh, that's a good. Well, I think patience has always been patience. Like, you just have to be patient, particularly in these places where things play out over a long period of time. I even learned, it's funny. I learned a lot of that just through all the crises I lived through. And like I lived through so many, as you have lived through so many crises, and they're violent. They're more and more violent every time they happen. And so you have to one, you have to be patient, and two, you have to be liquidity. Liquidity is so important in everything you do. You just have to have the liquidity to get, because the capital is not going to help you when you need liquidity. It's just, you just can't get there in time. And so patience and liquidity, like all the time in anything you do when you're managing people's money, are the kind of the most important things. And so hopefully I live by that a little bit.
That makes a lot of sense. And now we do have some youngsters listening to to this podcast as well. Many will be leaving university this year or soon. What advice would you give to youngsters as they enter the real world after university?
Oh, find the thing you have passion in, and you have patience too. Like careers happen over time, so you find that right situation, and then once you find that right situation, just be as all in as you can be with that company and what they're doing. This is a long road, man. You look at the projects we're doing are 20, 30, 40, 50 years long. And some are venture capital like. It's like where we're doing in carbon removal projects in the sense of technology from the air, versus we're planting trees on the other side. So there's everything to do, but it plays out over a long period of time. So you need to have patience, but find that passion and you'll have a great career. There's lots of good jobs out there, and lots of fun to be had.
And then the question is around your daily routine or productivity hacks. Obviously, you've had lots of big jobs, managed lots of different things. Right now, this organization is kind of almost like a startup in some ways.
Yeah.
I mean, how do you manage your time? How do you make sure your productivity is good? Like, are there any sort of secrets there?
Yeah, well, I'm still adjusting to the not going to the office every day. I work from home sometimes. I'm in our office here now. But I really like the balance of having an office to go to. So I'm in the office 4 days a week. I'm right now I am in our New York office, but we have an office also in Marina Del Rey and outside of Los Angeles. And so I do that. And then I still travel around. I want to know my customers and meet them. So I'm on with customers and seeing customers all the time. I always do that at the bank, and I'm doing that here. And then it is a startup. We have 30, I think we have 40 people now. It's been 3 years, and we're signing big contracts now and really, really in the growth phase. So my routine is just five days a week in the office for them and doing things like this, but on the phone with people as much as I can, because now more than ever, knowing people is important. And particularly in this, where you work on these things, then it takes a long time.
Yeah. And then the other question I had was on books. Are there certain books that really influence you early on in your career, or maybe or recently, the books you've liked? Anything you'll recommend?
Well, I love all things science fiction. I'm not sure that's what you had in mind.
Yeah, no, that's right.
I love the Red Rising series. If nobody's ever read the Red Rising series.
Yeah.
But the book I always I love almost the most was Shoe Dog. And Shoe Dog is the story. It's Phil Knight's story.
The Nike story.
Yeah, but it's up to the start of Nike. It's like everything that happened to him before he got to Nike. He was an accounting professor at Portland State. He worked at Ernst & Young or one of those places, and he was selling shoes of a Japanese company. I think it was ASICS. Was it ASICS or Onistuka, out of the back of his car, and how the banks treated him, where he got his money, how he built. And it was a startup, man, a real startup and labor of love. It's a great story for anybody about, look at what Phil Knight did to start that company and how it started. It's a real good read.
No, that's excellent. Now, final question is, what's the best way for people to connect with you, reach out to you, learn more about Rubicon? Where should they go?
Well, they can contact us through our website, rubiconcarbon.com. I'm on LinkedIn, so you can send a LinkedIn to me through that. My email is just tom@rubiconcarbon.com. So if you want to reach out to me that way as well, for any questions about this, I'm learning every day. It's fascinating stuff to learn about, and I love that we're planting trees and taking carbon out of the air.
Yeah, that's fantastic. Well, that was a fantastic conversation. I learned a huge amount. Keep up the good work, and thanks for coming on the podcast show.
Thank you. It was great. I appreciate it.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.